Hey, Tyler, Plug Power reported earnings and then they announced their conditional loan approval for the big Department of Energy loan they've been trying to get for 6 months or so now, maybe a little bit longer. But we're going to do a deep dive into the company's earnings, talk about what's going on, where we stand with the business today, and how investors should be thinking about going forward. You ready to take a closer look at the latest numbers from Plug Power?
I am. We brushed on them a little bit earlier in the week with the announcement of the energy loan and the big stock pop. I think this one deserves a little bit more attention, especially for people who are still considering this stock.
Yeah, the numbers really matter a lot, and they continue to be not favorable for Plug Power. We're going to get into the details of that in just a minute, though. This is Investing Unscripted. I'm Jason Hall. Tyler Crow's with me. If you're looking for even more great stock ideas in your journey to create wealth for yourself and your family, you should go to our special link. You see it on the screen. It's fool.com/unscripted. Go to that link, check it out, because the Motley Fool is going to give you its 10 best stocks to buy right now. Again, the link fool.com/unscripted. You'll see it on the screen for the entire video. Be sure to check it out. All right, Tyler, let's get into the guts here. Here's the company's press release for earnings. Let's talk about how the company did.
So here was a couple things that stood out to me. They obviously want to put together when you open up any press release from any company ever. The first few things are going to be the absolute best way for them to present the results. And one of the things that management has talked about in previous ones was cash and inventory management. If we go back a couple quarters, they had talked about being a little light on cash. It was a very large inventory build up all this infrastructure so that they could start to convert this to sales. And one of the things that they said is we've got to manage our cash better. So they're going to say things like an enhanced focus on cash management and how the losses on some of their fuel contracts are coming more in line, how their cash from operations is not quite as bad as it was the prior quarter, and a lot of other things, and basically trying to give the best presentation of what those was. But if you start to actually go down into the numbers themselves, and that's where things start to get a little bit fishier, right? So the biggest argument for Plug Power in for any investor is this massive growth story. This is a company that said not too long ago they were going to have about
20.
$1 billion worth of sales by 2030. So there should be some reasonable expectation that year over year we're going to see increased sales. But that wasn't necessarily the case this quarter. So on the year over year numbers, comparing from the first quarter of 2023, revenue was down about 47%. And if you go specifically into the numbers for the quarter, the largest decline in sales that we saw came from its sales of equipment and its related infrastructure. It was down about 63%. Across the board, they showed revenue growth in a couple of other things, power purchases agreements, fuel delivered. There was, I guess you could say those things went up, but they didn't come anywhere close to offsetting the sales of its infrastructure. And if you're building out a network, I guess you could call it almost the razor and blades approach, where you have to put out a lot of equipment, which is probably relatively low margin. And then the objective being is that you sell services such as fuel, such as deliveries, all that stuff at a much higher margin. So in theory, that should work. But at this early stage of the business, this should be a company where you're seeing larger increases in sales of equipment because we're bringing in new customers, things like that. That wasn't really the case this quarter. Now, you're supposed to give the benefit of the doubt when it comes to a single quarter. But I don't know. This is one of those things again, and perhaps it's because we're very skeptical of this company, both you and me. But there's just some components of this that don't quite add up. Even though we saw a significant decline in sales, the cost of revenue more or less stayed exactly the same. And that's where, Jason, I think you can jump in here and explain like the fixed costs with this business didn't really change much.
Yeah, and there's the devil's advocate side here that the company is trying to build it bigger, and cutting back on those costs right now would be detrimental. So, for example, I'm going to just switch to this real quick. If you look at their presentation for the quarter, they said that they're expecting about a third of revenue for the year is going to be in the first half of the year. There's that devil's advocate argument that if you start cutting back right here, it's going to be harder to make your two-thirds of your year in the second half of the year. So that'd be the devil's advocate argument. The problem, Tyler, that I have with that is the company has consistently failed to meet guidance and expectations for many years. This is not a startup company. It's not like somebody came up with the idea of Plug Power 10 years ago and started it up, and then they just went public 4 or 5 years ago. This is a company that's been around for a quarter of a century, and they've never made money. So that's why I think you have to be incredibly skeptical of the business. And this is the big thing here. We're talking gross level. You haven't factored in any of your operations, R&D spending, running your home office, your salespeople, your customer support people, your accountants, right? And this, they've had issues before with their financial statements, right? So probably need to be paying their accountants, considering that they've gotten their hands slapped by the SEC before. The point is, you haven't even factored in your $100 million last quarter of operating expenses, and you've already burned $159 million. You're literally selling $279 million for $120 million. That's what you're doing, is you're selling $2 for a dollar, is almost how the math works. So it's incredibly painful, Tyler. The argument that you're going to hear from bulls of the company is that it's the pain right now to try to build something a little bit bigger. The point is, the company's never delivered. As much as management said we had the problems with hydrogen supply and buying it on the secondary market was really expensive, and we still are having issues trying to bring everything up with our in-house manufacturing of green hydrogen. And then they said at the end of the quarter, they finally started getting production from those green hydrogen facilities, right? So now they're making green hydrogen. The expectation is that in the second quarter, we're going to start to see the benefit of the production of green hydrogen, not in higher revenue. I'm going to bring up the screen again, and I want to share this because they're not saying that it's necessarily immediately going to help them sell a lot more hydrogen. They're saying that it's going to help bring down this line right here, that $59 million that it cost them to procure hydrogen and related equipment related to delivering hydrogen, again, cost of goods sold versus the $18 million in revenue that they generated it from. That is a brutal difference in cost. You're talking about having to cut your hydrogen costs by, I don't know, 80%, Tyler, to make that math work. It is still a brutal difference in cost of goods sold. And that doesn't offset the massive amount of cost that you put into making hardware, and your revenue in selling equipment declined an enormous amount. Let's look at operating expenses. And they'll say, hey, we brought operating expenses down $100 million versus $140 million year over year. That is positive. That is definitely a good thing. I think you can also say it's good that their R&D spend was still roughly in line. They didn't really cut that. They did lower a lot of operating expense. That is a positive. But you're still plowing so much money just into making stuff that you're not selling enough of to foot the bills. Tyler, let's move up back upstream to the balance sheet, because this is a really important part of the story as well. We mentioned that $1.66 billion conditional approval for the Department of Energy loan. We've got another video that we did earlier in the week that's already out for that if you want to check that out. This is what I really want to talk about. So current assets, this is basically cash plus all the other stuff that you have that can be quickly turned into cash. Inventory, accounts receivable, so that's monies that are owed to you that should be paid pretty quickly. And that number hasn't really changed a tremendous amount since the end of the year by the first of the quarter. Liabilities, total assets is actually down a little bit. Then we move down to liabilities. Current liabilities is down just a touch, but again, a massive amount of current liabilities. This is basically money you owe in the next 4 quarters. That number has come down a little bit. Total liabilities has come down just a little bit, but you're about to add a big liability to this. You're about to add $1.7 billion in debt, assuming that conditional loan approval gets turned into a loan. And they haven't proved they can actually turn the money from however you raise it, capital, into assets that generate positive cash flows. So I think investors should be really cautious there. We talked about all those losses on the operating statement. I want to share something really important to talk about how they have raised money and how it has harmed investors right here. So they began the year 589 million shares. They ended the quarter 641 million shares. So in one quarter, they've increased shares outstanding about 9%, Tyler. One quarter, they've increased shares by 9%. The company doesn't bring in enough cash to cover its costs. It doesn't have enough money on its books to cover expenses. They need that loan for a lifeline, but they're yet to prove they can turn capital investments into cash flows to make this a stable business. Tell me I'm wrong.
You're normally the positive one, so I don't really know what I can say that's going to tell you that you're wrong on this one, because I agree with everything. This is a company that's just been eviscerating shareholder capital for decades, and there doesn't seem to be any silver linings in sight. If we come back here 3 years from now and All this has completely turned around. Gross margins are positive. Operating margins are positive. I would be shocked, and I will give my mea culpa on all this and say that I was wrong. I don't think I am,
Well,
and I don't think
one
you
last
are.
screen share, and we'll wrap this up here. And guess what? Management is saying just that. This is from last year, about a year ago. This was a 200-page presentation that they put out there, and they said by 2027, they're going to be generating $6 billion in revenue at 32% gross margins. Again, the company is so negative gross margin, I'm not even going to bother to try to figure out the percentage. And they're saying by 2030, they're going to be generating 20 billion in revenue. So they're basically saying 6 years from now, they're going to 10x the revenues and they're going to generate massive gross margins. Management's saying they're going to do it. And I know the Bulls are going to say that still could happen. I'll say it could happen, but like you, Tyler, I don't think it will. As Maya Angelou told us, when somebody shows you who they are, you believe them.